Bloomberg analysts believe that the likelihood of the oil rally to $100 per barrel is growing all the time. Besides, Wells Fargo Securities raised its bullish forecast for the S&P 500 at the year end to 5,535 points. According to one of the Bank of America's scenarios, the dollar-yen pair could potentially reach the level of 116. Oddly, the yen could extend its catastrophic weakness despite the authorities' efforts of forex interventions. Moreover, JPMorgan believes that budget deficits and military conflicts could force the central bank to hike the funds rate even to 8%. You are certainly aware that the funds rate in the US is now maintained at about 5.5%. All forecasts suggest the timing of rate cuts but not rate hikes. By the way, the exchange rate of the Japanese yen will largely depend on the actions of the Federal Reserve. Perhaps the Bank of Japan began to raise its key interest rate in anticipation of early monetary easing by the US Central Bank. Indeed, the yen is highly sensitive to the difference between US Treasury yields and Japan's government bonds. The elevated Fed funds rate entails high Treasury yields, and the strong US dollar, perhaps stubborn inflation in the United States, could force the Fed Reserve to cancel its plans for 3 rate cuts until the year end. In this case, the yen will be doomed for more weakness. Meanwhile, the Japanese yen is trading at historical lows due to the difference in interest rates in the two countries, while in the United States the funds rate exceeds 5%. In Japan, the key policy rate remains at an almost zero level. Accordingly, the US dollar is preferable for the yen because investors can gain higher interest rates by simply storing their money in the United States. This divergence effect was confirmed by Japan's current account data released yesterday. The report looked a decrease in capital inflows into the country, 2.6 billion yen instead of the 3 billion projected. The combination of the fact that the Bank of Japan will refrain from raising interest rates in 2024 and the US Fed will postpone rate cuts and will push the dollar-yen pair up. Crucial inflation data will be released in the United States tomorrow. The last 3 CPI reports showed stronger than expected inflation acceleration. That's the downward trend observed at the end of 2023 has hit a speed bump. After all, after the publication of the US non-farm payrolls, more experts believe that the US Central Bank will reduce the key rate only once or twice this year. Some economists even admit that interest rates will remain at the same level throughout 2024. Chicago Fed President Austin Cosby raised the question yesterday of how long the regulator can pursue its hawkish monetary policy without causing damage to the US economy. For comparison, at the end of 2023, analysts predicted 6 or even 7 rate cuts. As most investors alert to the US inflation data, the dollar is trading steadily. Its price, according to the index, which measures the exchange rate of the American dollar against a basket of currencies, is moving today in the intraday corridor between 103.90 and 104.20, while dollar bears are trying to seize power. Stock markets prefer not to take risks ahead of the release of the inflation data tomorrow. Therefore, Wall Street indexes remained flat on a Monday, and the S&P 500 today continues to trade very quietly within the intraday corridor of 5,197 to 5,220 points. As for the euro-dollar pair, today the market situation is generally similar to yesterday. The macroeconomic calendar is absolutely empty, and the trading charts stand in narrow corridors. However, after the opening of the American session, the dollar weakened a bit, although there are no widely fundamentals for weakening the greenback, so the euro-dollar pair is likely to return to the values it traded yesterday. In the meantime, the euro-dollar pair is following an upward trajectory. Its chart has left the support of 1.28 and is directed towards the upper border of the range of 1.2853 to 1.2886. Analysts suppose the euro could update the local high of last week. If the euro asserts its strength, there will be an attempt to break through the critical resistance of 1.09. This move will help the euro bulls to take their lead. Besides, the instrument will recover almost in a full relative to its decline in March. If the euro-dollar pair fails to stay above this level, the euro risks falling into a sell-off again. The bears cannot seriously threaten oil prices, and the Brent price has already jumped above $90 a barrel amid military tensions between Israel and Iran. But the main reasons for the oil rally are somewhat deeper and are based on a global decrease of suppliers in the oil market. OPEC and its allies announced that previous production quotas are still valid. Mexico's recent move to reduce exports also did not add optimism. After all, rising oil prices mean a new round of inflation, which all leading economies are now fighting against. Judging by the movement of a Brent in the range of $90 and $91 per barrel, the market today is trying to correct itself after long and large-scale growth. Extremely significant factors that contributed to the growth of oil prices have not gone away. Yes, such drivers are no longer able to push prices up, but they do not allow them to fall either. Much will depend on the geopolitical situation. If it escalates as before, then forecast for the growth of oil prices to $100 per barrel will be realistic. In any case, the movement of the Brent chart above the level of 90 confirms buying activity, even despite clear signs of the asset being overbought. If the information background continues to fuel demand for oil, a full-scale correction of oil prices may not occur at all in the near future. In this case, the Brent benchmark will be ready to update the local high. You have watched the market review by InstaForex analysts for Tuesday, April 9. Subscribe to InstaForex TV channel, and we keep you updated